In this week's update, why the huge and rapid repositioning in the AI tech sector. Most consequential earnings cycle in the entire AI build-out is coming. What a disciplined process achieves. And Friday, it's not the confirmation of a low, but what is needed for that to occur. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Such a week to unpack. We had a lot of significant volatility across the market, really, not just in AI, but across the whole market, and particularly in commodities, with materials sectors being hit very hard around the world. So I think at the moment we're at a shorter to medium term AI crossroads. There's little doubt there's no doubt in my mind about the long term. So that's not in question. It's just what happens in this transition period between now and getting back on the track that everyone thought that we were on. So the AI character has changed significantly over the last 6 weeks, and I've been pointing to this just by looking at the charts. Nothing else magical about that. The long-term structural opportunity remains, no question, but we've got a situation where the short-term balance between the buyers and the sellers has changed. And the leverage that occurred, particularly in single stock, double and triple leveraged ETFs, has really accelerated that shift in balance. So we had an extremely crowded trade within the AI sector, but it's readjusting very, very quickly. So the warning is also broadened. Started with memory stocks, became volatile and unstable because of this leverage and because of several other factors, and then it spread very quickly. And we've now got a somewhat unpredictable unwinding of that leverage. So this is forced selling. And you have to make a distinction when you're deciding what to do with your portfolio between forced selling, which tends to be very shorter term and transient, and something that might go on for a longer period of time, which is more about perhaps valuation or economic proof, whatever that may be. So we are in this period where it's pretty uncertain and unclear where things go in the short term. So when you find yourself in that sort of situation, this is really the theme about today's video, is you've got to have a process. If you're trying to predict, was that the top or is this a bottom? Do we buy the dip? It's just completely wasted effort and will get you on the wrong track because it cements an idea in your mind. And so naturally you just go and look for the evidence that supports that view, and you lock out other evidence that might be screaming at you that you shouldn't be exposed the way you are. So if you're listening to the predominant narrative, if you're on social media and expecting a group of other people who don't know what's going on either to tell you what you should do, then you're certainly in a lot of trouble. The way to go about it is to change your weightings, change your cash levels, take some partial exits according to good, solid, repeatable exit rules, put stops in place. But overall, you want to go to a much more conservative stance and reduce exposure. And that's what we've been doing. That sort of approach to the market is repeatable. You can do it cycle after cycle after cycle, no matter what comes along, whereas predictions are not at all repeatable. Friday was a signal, but it's certainly not confirmation, because we saw a huge gap down after another really big hit on the Korean market, the Kospi. So US market gap down significantly, then traded up very robustly. And some commentary is taking that as a signal that that is a bottom and they've reversed. My position is that it is far too premature to call it that way. It might be, but that's a gamble. And at this point in time, I think that's a low probability gamble. So we saw an intraday recovery, which you can look at two ways. You can say, well, okay, buyers are present. Some people at least are prepared to step up. So that's a positive. But when we see the negative close, as we will when we get to the charts, the low remains unconfirmed from my point of view. So this is not a buy the dip scenario, not yet, based on probabilities. I don't know whether it's the low or not, and frankly, I'm not thinking about it because it's pointless and it's negative. So I'm just following along with what the market is showing me. And at the moment, Friday's close was quite indecisive, and that's about all you can say about it. So you need more information. What was constructive is that SMH, which is the main semiconductor ETF, was down 5.7% early. Then it managed to scramble back and just get into the positive on an intraday basis. And I think part of that was we had so much panic selling, and then perhaps a bit of short covering kicked in as it started to bounce. Whatever the reasons, they don't matter. But it finished in a quite indecisive manner because that recovery, that intraday recovery, didn't hold. So it doesn't qualify from my perspective. And also the NASDAQ, the overall NASDAQ, not just semiconductors, finished up down 1.4%, which is a decent amount. So semiconductors are now down 20% from their peak. They have been much, much later in going into that consolidation, as we'll see, and they've broken key support. So we've just got to wait some more to see where we go from here, but there is nowhere near enough evidence that the decline is finished. So let me just take you to those charts of SMH. And I think it's worthwhile looking at the journey that we've been on. So if you look at phase 1, which is from here through to here, we had an oversold reversal in the period from March to April. And what changed is that AI and tech had been hit by the macro events, by the war, by the fears of AI disruption. But then the price action turned well before the news felt comfortable, and that's just here. So as we start to move into phase 2, you can see what a meteoric rise that it was. So we respected that reversal, as many, many others did, and we restored our exposure quickly to what is still the strongest structural trend. No matter what else happens in the next short period of weeks or months, this is still the strongest structural trend out there. So rather than waiting for certainty, we started to rebuild our exposure. Now, phase 2, which was really the period from May to June, was where the leadership became very extended. And what had changed here is that AI and tech had become the dominant source of index strength. If you look at the percentage that it made up of the index gains, it was at quite an extraordinary level, and it included memory stocks, semiconductors, stocks in the business of providing power to data centers, cooling to data centers, and networking. That all accelerated. So the strong fundamentals were real, but the speed of the move and the concentration of that positioning in a few really large names. Now, these are trillion-dollar companies, Micron and SK Hynix and Samsung. That concentration plus the leverage just reduced the margin for error. So that was this phase 2 here to when we hit the top at the end of June. Now, moving forward, we moved into phase 3, which is this little bit here around late June. So this period from here, from the top down to the first significant break that we got, which was on the 2nd of July. So all this has happened very, very recently. And what changed was that we had the impact of these new leveraged ETFs. We had margin borrowing, we had retail speculation, and that was all piled on top of what was already a really powerful trend in memory. So you can't just keep throwing logs on the end of the cart and expect it all to hold together. And what they found in Korea was that the exits for all of those positionings to get out was too small. And so we saw dramatic movements of 10, 15% in a day in trillion-dollar companies. I mean, you just got to step back and look at what's going on. That should have made anyone and everybody extremely skeptical. So memory did not cause the decline that really accelerated last week. There were lots of other factors that did that. So that's phase 3. And phase 4 is that the good news, and this is really the confirmation that we've seen a significant high point. I won't call it a top because I don't know whether it is or not, but there has been a significant high point in the semiconductor market because good news is now not getting a positive response from the market. So we have a change in sentiment, a change in character. And what has changed, of course, is that, or the evidence of that is that Micron and Samsung both delivered extraordinary results, extraordinary demand, and evidence of they can almost charge what they like. So their margins are amazing. And then that was later confirmed a couple of days later by Taiwan Semiconductors. So they've again reinforced the infrastructure demand. So the demand issue is not at all in question. But the result of that, how the market treated that evidence, has changed 180 degrees because stocks and the sector have weakened. Normally those results have and would have increased the price. But what we've seen is the price is on its way down. There are other structural forces. The forced selling is overwhelming the fundamentals. So that tells you the market has changed. So the pivotal signal is that the market has moved from rewarding proof of demand to questioning the company's positioning and the economic return. And that is why the earnings season that starts for a lot of these guys next week and extends through for a month or so after that is just so absolutely critical. All right, let's move on. What is really important when you get in periods like this is planning and organisation and clarity of thought. You've got to keep it really simple and you've got to be able to know where all the points of evidence you need to go are. In the next 6 weeks or so, there are 32 major stocks that are going to impact what the market does reporting. And we're going to be on top of all of those reports, but it's not just the report themselves, it's the outlook statements. And it's also the market's response, which is probably more important than any of them. So yes, results have got to be good. Yes, guidance has got to be really strong. It's got to beat expectations. Meeting expectations is not going to cut it in this next earnings season. But it's the market's response at the end of the day, because as we've seen with Micron and Samsung, the market can react very badly, even though the results are incredible. So we really are at a very, very important crossroads. And I'll just show you a chart to give you an idea of what we're tracking. There's the chart that we are tracking. So I know it's a bit busy, but let me try and quickly explain it to you. So across the top, we've got the hyperscalers and the main platforms. So Google, Microsoft, Meta, Amazon, etc. So that is extending through to the 7th of September. So that's the first line. Then the second line, we've got the compute foundry stocks, Intel, Advanced Micro, NVIDIA, etc. So NVIDIA comes in late August. So it wouldn't be a bad idea for those that are interested just to make a note of these dates. Then the memory stocks will be coming up soon. Then we've got the networking and optics stocks, and so on and so forth as we go down the line. So for the next 6 weeks, we'll be critically watching all of those results, but more particularly the 48 to 72 hours after those results hit and how does the market respond? And that will certainly feed in to our view on the market. So we're going to be all over that in the next 6 weeks. So just running through it again then. So the hyperscalers are just so important. Next week is such a critical period. The market will be looking at obviously revenues, the way that the assets are being utilized, the margins. But it will get down to looking at the return on investment for their customers, because their customers have to be able to sustain this as well. What is the payback on the capex? So at this point in time, we're not anticipating any disasters, even though the market response might be a lot more volatility. But that doesn't mean that the fundamentals have necessarily changed, because remember, we've got a lot of transient impacts on the market that will flow through, they'll wash through reasonably quickly. So we're seeing this as a positioning reset, but we don't discount the possibility that this could end up in a bit of a global economic scare, depending on what the results of the hyperscalers and their outlook statements have to say. So our takeaway for investors is that you should have some higher cash levels, and that means different things to different people. But let the evidence determine when you should reduce your exposure or raise your exposure, or the opposite with cash, if you know what I mean. So this is a period for being quite conservative. Not a time for heroes here at all, or listening to social media for opinions on where other people who haven't got a clue are postulating about what the market might do. So the reason that we say that this US earnings season could really move global markets, not just those sectors in the States, is that the hyperscalers are amongst the biggest weights in the US indices, as everybody knows, and they absolutely anchor global sentiment. The American market sets the sentiment for the rest of the world. Whether you like it or agree with it or not, that's the case. Because their capex is obviously financing the revenue pipelines of all the chip makers, the memory stocks, the networking, the optics, power, cooling, data centers across the whole world. So if the hyperscalers show any chink in the armor, that is going to cascade down through the whole food chain. Now, that says nothing about the benefits of AI or the long-term outlook for AI, from our perspective, unchanged. But it could cause some short and medium-term disruption that could be nasty, because there is so much expectation built into this, and there are so many crowded trades. When crowded trades have to be unwound because they're built on margins and leverage, then this is not about a value judgment anymore. People won't stop selling because collectively they think, oh, well, the value's been restored, it's all good, we'll get back to normal. They have to keep selling because they have to. So you've got to understand that there's two parallel dynamics running here. One is the dynamic that is justified by the outlook and the value, and then there's this other dynamic that is causing this incredible volatility of crowded trades. So it's likely that any little stumble with the hyperscalers is going to have a much wider impact. Now, where do we sit? Little old Australia, we're downstream in terms of the global risk appetite. When the world is in a risk-off mindset, then Australia always cops it big time. It'll hit local technology valuations, it'll hit data center contractors, it'll hit critical materials, and it'll hit the Australian dollar. Now, I'm not saying this is going to happen, not by any stretch of the imagination, and hopefully the hyperscalers give us the picture that the market wants. But I'm just signalling that you need to be cautious and careful, because there's a whole lot of other dynamics that are not about fundamentals that are going on. So let's have a look at why our process worked, because having a process, a repeatable process, is absolutely critical in times like this. If you don't, if you're just responding to your feelings, responding to the media, then I can almost assure you you're going to lose money, because it's terribly difficult to know which way to hop in this kind of market. So our process worked because it's simple and it's repeatable. We start with quality assets in sectors that have got structural tailwinds. So that gets us in the right fishing hole, and you've heard me say that many times before. And then we just let the money flows guide our timing. We read the charts to discover who's controlling the market, not who should control it, but who is. Because strong fundamentals just aren't going to do it when we've got forced selling. We manipulate our exposures with weightings. We avoid making any calls that, all or nothing. Not that we do, but I know there are plenty of other people out there who feel they want to be a star for a day and make a hero call. You're probably going to lose money. You need to pre-plan your response. A lot of people kind of look at me funny when I say pre-plan your response. How could you possibly know until the market's done it? Well, you can. You can decide in advance before you even buy an asset what you'll do with it if A happens or if B happens. And we're continually challenging our members with that to reevaluate their portfolios, to ask themselves that question in terms of when they look at exposures. And if they're not comfortable with that exposure, then do something about it. You can do all that in advance of the event. And you've also heard me say many times, we do not have to be victims here. Just copying whatever the market delivers. You can pre-plan and control more things than you can't in the market. So we're just working the probabilities. Our conclusions follow the evidence. Now, one thing which is really important is that this is I call it a 70-30 situation. If we can be right 70% of the time, or if we can not be right, because that's not the correct terminology. If we can get a positive outcome based on our repeatable process 70% of the time, that is a tremendous position to be in, and you'll do extremely well. So that means that 30% of the time we don't get the outcome that we wanted or expected. And this happened with precious metals. Our timing expectations around precious metals was either early or wrong. I think the jury is still out on that, whether it's wrong. I hope it's not wrong, but it was certainly early and we've been caught unawares. Let's have a look at the chart of gold to see how things sat in early March, or I'll just run through these points first. The gold price had risen 65% over the previous 6 months. So the market was bullish. It was as bullish as it was on memory stocks a couple of weeks ago. It then looked like buying a bigger consolidation or a dip looked as though it would be the ideal play because the fundamentals were fantastic. They were all pointing to the upside for gold. And the chart patterns basically played ball with that. They were in alignment with that for about 6 weeks. And then the war changed everything. So it looked like continuing to have significant exposure to precious metals to the upside looked to be the ideal play. The war started, so the circumstances started, and that just changed everything. And so the point that we're making is that the fundamentals were compelling, but the charts didn't confirm, and the charts started to deteriorate. And so at the time, and I made this particular recommendation in the Sunday video, is that we were rebalancing our portfolios into royalty stocks. A good part of the reason for that was the price and availability of diesel fuel for the miners to actually be able to run their operations. And since then, royalty stocks haven't done too well either. So this is one of the times where our repeatable process, didn't provide the outcome that we wanted. But did we abandon it? No. We just shifted our positions around, we shifted our exposure around, and we dealt with it as it unfolded. And that's all you can do. So let's look at that chart, because that's interesting, gives you a lot of insight into the way the market responds. So from August at roughly 3,400 in gold, by the end of January, we had a real blow off top, and then that certainly consolidated in early February, and then we bounced around for a while. So after this huge rise, you have to get a consolidation. So until we got to about here, I'll just mark that point. So until we got about here, this was all perfectly normal. This is what you would have expected, a volatile consolidation of a huge run-up. That's what you would have expected. So it was all good. But then the war started, And this was a couple of weeks after, so this was the 18th of March. And gold started to get hit, and that was because of the narrative around price hikes, inflation, all those sort of things. And we're now in the process of consolidating around some very important support. 3,900 to 4,100 is absolutely key. And I can't tell you at this time that I'm as confident that this is the bottom, because I'm not. There is no evidence here yet that the sellers are starting to step up. Now, it might start next week, I don't know. But the point is, I'm waiting until it starts. I'm not trying to second guess the market. So that's it. Often you're right if you've got a repeatable process, and sometimes you're wrong. So be it. Just get on with it. The worst thing you could do is abandon your process. So what are we tracking at the moment? So the hyperscalers, as you saw on that previous slide about reporting dates. So the hyperscalers are absolutely critical, and they've got to prove that AI revenue and cloud demand is scaling fast enough to support this ever skyrocketing CapEx. I mean, it seems like 6 months ago, these guys would announce $100 billion worth of new CapEx. Now they're announcing $300 billion worth of new CapEx. It's just, not only is it extraordinarily big, but it's accelerating. So they've got to prove that financially this is going to hold together, and that the new capacity is not just creating an excess supply problem for the future. Because if the market gets a sniff that things are not sustainable, then there is an awful lot of unwinding that's got to happen. So with the hyperscalers, the margins and the free cash flow, they need to be able to demonstrate that they can absorb these higher memory costs, which have just escalated dramatically, and be able to deal with all of the power and cooling and depreciation and all those other costs. They also need to show evidence that customers are getting measurable return on investment, because if that doesn't happen, then the whole thing stops. So CapEx, like as we said last week or the week before, CapEx needs to produce a visible payback. So the next 6 weeks, we're not looking for a silver bullet, because such things don't exist. We're not after looking at one magical element. We recognise that we're faced now with more uncertainty and more volatility than I can remember, because we've got this war going on, we've got geopolitics with China, we've got trade wars, all of that before you get to all these forced selling market dynamics. So for us, this is a period of gathering evidence, and right down to asking the question about what is it we don't know, because you can find answers to things when you ask that question, when your mind is open enough to ask that question. Just pose the question to everyone listening. Do you have the appreciation of where AI is headed and all the consequences that spin from that over the next 5 to 10 years? Because if you do, then you'll know that it's worth paying attention and just thinking a little bit about your own portfolio and your own approach to the market, because the pot of gold, I think, high probability is going to be amazing. But we've now got numerous uncertainties, and we've got to get through that period. I'm very confident that we're going to see some spectacular rebounds in stocks and sectors across the whole spectrum of AI, all the industry groups. I just don't know when, but I know what it looks like, and it's pretty obvious. And that will extend, of course, into other sectors as well, because this whole AI revolution is just changing everything. So it will impact all other sectors. We'll get V-shaped recoveries. We'll get basing patterns that'll go on for 6 months, look like they've gone to sleep. We'll see all kinds of different patterns. But you need to be able to recognise what is a valid change in who's controlling the market between buyers and sellers. So a lot to throw at you. This is the slide that we show every week, because it's probably the most important slide that we're going to show, and that is that you've just got to get yourself organised. You've got to get all your advice sources lined up. and take care in the market. So let's look at American stocks now. The S&P was down 1.55. The NASDAQ was down nearly 3%. And I spent a lot more time than I normally did on that preview because it's just so important that everybody gets the right perspective. A lot has changed in the last week or two, a huge amount. So it's important to have that perspective. The Russell did much better, was only down 0.7. So that's a real positive for me that US small caps are still holding up. If the market and the institutions started to think that this was a major peak in the market, the Russell would be down a lot more than there would be a real exodus, and there's not. This has been a rotation. It's not a movement out of the market, it's a rotation. The crowded trades are unwinding. The silly level of leverage is partly responsible for that. US dollar index didn't change a lot, still hanging around this 100 mark. The 10-year yield also didn't move very much. And the VIX was up and down a little bit, ended up 18.8. Let's go and look at some key charts. So we'll start with the NASDAQ. So there's no question we've got to change a character. I've been talking about that for weeks. So we'll take that as a given. Now, where do we go from here? Is this a likely base? Well, it's certainly one that we'll be looking at. But I don't think anyone can look at that chart and say whether it's going up, down, or sideways. So we need to wait. This is consumer discretionary versus consumer staples. Again, maybe a little bit of money flowing preferentially into staples, but it's not much. There hasn't been a great move there. We'll look at the individual US sectors over the last month. So at the top of the tree, we've got XLV, then energy. Finance came off a little bit towards the end of the week. On second look, the US banks' results and outlooks weren't all that terrific. They weren't poor in any way, but it's probably just the situation where the market is not looking for meeting expectations. It wants to see companies beating expectations because of the valuations. And then so on down the line, and we've got XLK right at the bottom, and you can see it's just absolutely fallen off a cliff. And if we go back to the last quarter, you can see XLK was up here. Now, when you look on a 1 month, it's at the bottom and falling quickly. In Australia, it's a real mess here. So that's the last quarter. Doesn't really tell us very much. Let's look at the last month. And that presents a different picture. Healthcare has certainly had a good period with strong bounces for stocks like PME, CSL, etc. Finances, the banks have been well supported, and energy has picked up again as the oil price has bounced. And you can see materials has been pretty much obliterated in the last month. So not a good look there at all. The S&P looks quite similar to the NASDAQ, just a bit less volatile. And there's the Russell, and that's on a weekly chart. So you can see the Russell has hardly changed since the middle of June. So that's pretty impressive in such a volatile environment. So that's a positive tick for the market. Turning to Australian stocks now, just under 70 cents for the Aussie dollar. Our index ended up flat for the week, but that hardly reflects what happened on Friday, which was a very nasty day here. There was just constant selling throughout the day. I'm talking stocks here, not the index, because obviously the index finished flat for the week, but certainly my portfolio, I think almost every single stock was down, and some of them were down significantly. And it was the nature of it. It just had the thumbprint for me of institutional hedging. I've seen that process before, and you look back a week later, and when you find out who's been doing the selling, it just kind of looked like that. It was just constant all day. Didn't seem to accelerate. We didn't seem to get any bounces intraday. It was just steadily down. Materials has lost 14% in the last 4 weeks. Incredible. Let's look at precious metals now. Gold down 2.5% for the week, just hanging on to that 4,000 level. We've come off a lot. Remember, we were nearly $2,000 higher than this just a few months ago in Australian dollars. So that's come off a lot. Earnings season in Australia for gold producers will be really good. So far, the results that have come through have been pretty impressive. Again, just highlighting this is such a generational opportunity in gold, but we're not there yet. And it could go meaningfully lower. So I wouldn't be recommending to anybody that you be accumulating gold stocks unless you've got certainly a good long-term view and you're prepared for some more downside, because I think at the moment, all the momentum is down. Silver was down 6.5% for the week. So look, this just defies the fundamentals, makes the point yet again that the main timing tool that you need to use are the chart patterns. Wait for the market to show you where the buyers are stepping up and starting to gain control again from the sellers. Now, if we look at gold stocks, it's pretty horrid. When I get there, it was an absolute shocker. And they're really in free fall is the best term that I can use. And you don't want to go buying into free fall. Now, I showed this last week, I think it was. What do we need to see for the major up leg to start? Well, that ratio between gold and the S&P needs to turn back up again, needs to flip over. Because while things are so buoyant for stocks and we've got the war in progress, we're not going to see any improvement in gold. We've got dual earnings seasons across both countries. And the normal pattern that occurs is that gold stocks will lead the reversal. But we'll see. Keep an open mind. So let's look at those charts. Look at silver first. So you can see the candle ranges are getting really small compared to where they were. So we've got high volatility, huge volatility through here. And you can see that that volatility is starting to settle down since the end of May. So for the past 7 or 8 weeks, it's getting slower and slower, smaller and smaller candles. So you've got to see that before you can see stabilisation. But will some event cause this to just turn around and rocket back up again? I don't know at this stage. There's the gold versus S&P ratio, so no improvement there. And there's the Australian dollar gold price. Now we'll just finalise with GDX. So this is GDX on the Australian market on a daily chart. This is just absolute freefall. Look at where we've fallen. We're at 115 on the index on the 1st of July. And in 3 weeks, we've fallen from 115 to 88. That is a very, very substantial fall. And we've also got a pretty similar kind of thing happening with GDXJ in America as well. So that's where we sit at the moment. There aren't too many corners of the market where you can hide at the moment, and that's why having some higher levels of cash, I don't think you're giving anything up. It's not like some sector is going to suddenly explode back up to the upside and you're going to miss out. So having some cash, being conservative, letting the market guide you is the way to go at the moment. All right, let's finish off now with other commodities. Copper didn't do a lot, 622. Crude oil did though. And I said last week or a week before that this was a pretty potent contrarian setup. Not that I would have taken it because it was based on completely unpredictable events controlled by one President, Donald Trump. So I don't think anyone would want to bet anything on that. And so it was that it has bounced back. But for what period of time, who knows? It's just all too hard. So that's commodities. There's the copper price. We're just bouncing around between $6 and $6.30. And there's the crude oil chart. Quite a nice rebound. But we're now coming back up into resistance areas. So to finalise, the market response is absolutely the key next week to the hyperscaler earnings and other sectors within that area as well. Forget about being right. It's such a misleading thing to do. I know that pumps our ego up a bit if we can make a call and be proven to be right. We feel like champions, but it's actually pretty silly and it's pretty negative. We're here to make money. That's it, pure and simple. When you get a call wrong, just be humble about it and move on quickly. Don't think about it. If you've got a loss situation, then the value of that money is already lost. It's already gone. And why people feel that they need to try and get that value back in the same stock that's going down defies logic. So it doesn't matter whether you're in an individual loss or profit situation, it's just not relevant. What we're doing and what I do personally is I just think of investments in stocks as a parcel of money. And I'm just moving that around, buying and selling. Not that I'm a short-term trader, I'm not. But over periods of months or years, I just move that cash around to where it's getting treated best. And that's how you need to think about the market. So that's it for this week. Bit of a long one, but gee, this is just such a critical point for a lot of reasons. So I'm sure I'll have plenty to talk about next Sunday. There's more information there on the website and there's my email address, and look forward to a stimulating week. Cheers.